Hi there, good morning and welcome. You're watching Power Breakfast on CNBC-TV18 in the Mumbai News Centre. I'm Mangla Malu. With me is Sonal Bhutra. We talk about the markets, of course. We will talk about all the cues that we're tracking. But this morning, everyone's a happy person in India, especially because what took place yesterday. Our boys in blue went ahead and decimated the men in green. So that one international relationship is taken care of, which is India versus Pakistan. India wins 7-0 all the last 7 cricket ODI World Cups. But the other international relationship which is a problem is India-US. US removed India from the preferential treatment or preferential status. Then we had India retaliating, and that impacted our markets.
Oh, absolutely. We did see a sharp sell-off in the last 1 hour of the trade. In fact, we are actually not waking up to positive cues as far as the global markets are also concerned. The US markets, they did close in the red, though it was quite flat, but it was in the red. In fact, the Asian markets, they are also indicating a mixed start. The European markets also didn't do well. So except for the India win, we are not having a lot of positive cues as of now.
But that's okay for the second of the positivity from the sporting arena. But let's take a look at how the Asian markets are faring. They're more or less mixed, if you must, trading more mildly lower in early trade as investors are bracing for a couple of things. One, the big central bank meetings later this week. This Wednesday, we will have the outcome of the US FOMC meet. Perhaps there could be a rate cut for the first time in a decade. So the Asian markets treading water ahead of that. Also, there was data release coming in from China last Friday indicating that the industrial output growth in May has slowed to more than a 17-year low. So in that regard, we will keep an eye out on how the Hang Seng and Shanghai markets open in a few minutes from now as well. The Nikkei absolutely flat, mild weakening seen in the dollar yen out there. The Korean markets about 0.2% higher. The Straits as well as the Taiwanese indices should come up for you. They are lower, so 0.5% shaved off both those indices. And in light of that, the SGX Nifty is indicating perhaps a bit of a mildest start to the tune of around 4 to 5 points in the red. So let's see how that comes about. Remember, over the weekend, we saw the crude oil prices move to around $62 per barrel as well. But it's a big week for central banks as investors are focused on monetary policy decisions coming in from the US Federal Reserve as well as central banks of England and Japan. CNBC's Martin Soom is here with a quick report on what to expect.
Huge week for central banks. So let's start with the biggest one, the Fed. The escalation of trade tensions has made the global outlook rather more murky. The markets are now crying out for easier monetary policy. Now, a lot of experts expect the FOMC to, well, comply. Maybe not at this meeting on Wednesday, but definitely later this year. We've got Fed funds futures pricing in about an 88% probability of the Fed pulling the trigger and cutting rates at the end of July. And we're going to be watching this meeting, Jay Powell, to see if he starts sending out the right signals. Across in Europe, keep an eye on the ECB's annual forum over in Sintra in Portugal. Not a policy meeting, remember, but the powwow is still a must-watch because Mario Draghi could broadcast his intention on where rates are headed. There's also a lot of questions about what will happen after Super Mario steps down in October, remember. Over in the UK, meantime, the BOE seen leaving rates unchanged at 0.75% Thursday. Mark Carney had previously stressed that rate hikes are still possible, but not a lot of people believe that, especially with the threat of a no-deal Brexit casting its long shadow. Out here in Asia, meantime, the Bank of Japan, BOJ, expected to stand pat on policy this week. A lot of people believe the Fed's dovishness could force the BOJ to follow suit, putting more pressure on Haruhiko Kuroda to ease.
All right, let's talk about the US markets then. On Wall Street, stocks closed lower on Friday, led by tech shares, which were the biggest losers in trade. The Dow Jones fell 17 points, the S&P 500 declined by 0.2%, while the Nasdaq Composite lagged, falling 0.5% at close. On the data front, US retail sales rose 0.5% in May, which was below estimates. CNBC's Josh Lipton gets us a wrap of all the action on Wall Street.
U.S. stocks finishing lower, the Dow falling 17 points, S&P off by 4, and the Nasdaq down 40. U.S. retail sales rising in May, while sales for April were revised higher, suggesting a pickup in consumer spending. Retail sales rose 0.5% last month as households bought more motor vehicles and other goods, according to the Commerce Department. Shares of Chewy, PetSmart's online business, soaring in its public debut on the New York Stock Exchange. Stock opening at $36 per share after pricing at $22 per share, above its expected range on Thursday night. Chewy finishing its first day of trading higher by 59%. A decade after the Great Recession, most Americans have yet to recover financially. According to a new study by Bankrate.com, more than half of the Americans who were adults during the 2008 financial crisis say their financial situation is worse off today than it was before the recession. More than half say their income has not grown since before the crisis, while 1/3 saying their paychecks have actually fallen below their pre-recession earnings.
All right, that's an interesting point. No growth in income since 2008 financial crisis. But on that note, here is some opinion from experts on the US market and Fed's rate trajectory.
We still have a positive earnings story. It's not maybe as robust, but we got through the first quarter. The fears were we were going to see year-end negative earnings growth. Looking forward, we continue to see some acceleration in that earnings gains. And arguably, with interest rates having falling, the hurdle rate under which you want to start thinking about stepping out into the equity market from holding fixed income remains a compelling trade on a relative basis. So, equities are able to look to the prospect of earnings and lower hurdle rates. I do think that you start looking to some risks that come out of the trade conflict. The risk that most people have looked to has been this idea of what happens to margins.
Stocks are, number one, expecting that the Fed is going to prop us up in the meantime, and then eventually we get a trade deal. So it's like we're just expecting the next 6 months to be kind of preventing a nosedive in the S&P from the Fed, and then we get a trade deal maybe late in the year and everything takes off. I don't think the market's ahead of itself in thinking that the Fed has our back. I think the market's ahead of itself in thinking that the Fed needs to have our back. I don't think that there's enough data telling us that they're going to need to prop this up throughout the year. And now I think we've got 3 cuts priced in through the end of the year. The Fed funds futures is almost the market's wish list. The market would love for the Fed to cut rates 3 times and just prop up stock prices, but that's a short-sighted goal.
Appreciate the point about the GDP tracking now 2%, but I think as the Fed, you have to look at the preponderance of evidence and sort of the other indicators, the forward-looking indicators. So if you look at global PMIs, we're just on the cusp of 50. If you look at new orders from those PMI indices, they do not look good. And then you couple that with a payroll story that we got last week. If you look at employment, the cyclical sectors of the economy are basically created no net new jobs for the month of May. Then you couple this with the inflation story. Core PCE inflation for the duration of this business cycle has undershot the 2%. And that's what the Fed is currently debating. Then on top of that, you throw in some trade uncertainty, business confidence that is starting to pull back. And I think that's what's ultimately driving the economy.
All right, and across the Atlantic, Middle East tensions actually weighed the European indices lower, so the European market should come up for you. They closed in negative terrain on Friday as tensions heightened between the US and Iran, and this after following attacks coming in on 2 oil tankers in the Gulf of Oman, where the US indicated that perhaps Iran was the perpetrator of that crime. We had the German index sharply lower by about 0.6% on account of weakness that we saw in the auto space, and we should get the ATHEX as well as the Brazilian indices up for you. Remember, the ATHEX has been outperforming after snap elections have been called in on July 7th. However, some profit taking seen out there, and the Brazilian index lower by about 0.75% as well.
All right, let's talk about the currency space. The dollar hovers around a 2-week high as strong US retail sales data released on Friday tempered some of the fears about a sharp downturn in the economy. Meanwhile, the yen holds steady versus the US currency.
In the world of commodities, crude oil prices rise as West Asia remains tensed following the attack on 2 oil tankers last week.
We've had no physical disruption of oil to date, so I think the market is taking a sort of wait-and-see approach. I think until we can get beyond demand concerns, geopolitics is going to have a hard time pushing prices much higher unless we get a major disruption. I don't think oil prices reflect the degree of severity in the Middle East right now. I mean, the key question is, what is the U.S. response going to be? We've come out and blamed Iran now for attacks on 6 tankers in the past month. Are we going to intensify sanctions? Are we going to deploy more military assets to the region? I think the U.S. response will be very important. And also, what do the Iranians do next on their nuclear program? So I think those are the factors to watch in terms of where the crisis is headed.
All right, back here watching Power Breakfast on CNBC TV18. Well, back home on Dalal Street, markets fell for the third consecutive day on Friday. Both Nifty and Sensex ended the day over 0.5% in the red, and the broader markets underperformed the benchmarks. Banks led the fall as the index ended over 1% lower, and the mid-caps fared slightly better. Nigel joins us to get us all the market cues we need to know for trade this morning. Hi, Nigel. Good morning.
Hi, very good morning, Mangalam, as well as Sonal. Well, as you all said, in Friday's trading session, towards the final hour of trade, we saw a sharp sell-off. So the intraday chart tells you that, the relations with United States, that's something that worried us in terms of those tariffs that will be imposed as well. So not great news. To sum it up, really, the Nifty was on a 3-session losing streak. We ended below that crucial 20 DMA odd mark, though towards the end we saw a bit of a pullback to end a little above the 11,800 odd mark. The problem is the breadth of the market. For all the trading sessions in June itself, it's been firmly in favor of the declines, telling you the breadth of the market is rather weak. And last week as well, the Nifty ended down 0.4%. You had the mid-cap index as well as the small cap indices. They were down between 1.5% to around 2% odd. So telling you that these small and mid-cap stocks, they're still not finding favor. And if you're comparing us, we were relative underperformers with the emerging market basket as well. The Brazilian index ended lower with a cutoff around 1% in Friday's trading session. That's why that index ended flattish for last week. The Shanghai market did well, while the Indian markets ended in the red. In terms of flows in Friday's trading session, the FI sold. They sold only around 250 crores approximately. Yet we ended, with such a sharp cut. While the DIs, they offset almost all of that. So net institutions, in fact, they were net buyers to the tune of around 150 crores approximately. In the FNO market, the FIs, they added longs. They bought calls as well as puts. But they're writing calls, telling you the upside is likely to be capped at around the 12,100 odd mark. So in terms of the long positions, they added nearly around 6,000 long contracts. Their net long on the index, nearly around 59-60% of their positions are on the long side. And if we're looking at the options data, well, they bought 13,000 calls as well as nearly around 13,000 puts, 13,000 puts as well. So they're buying both calls as well as puts. But the problem is they're writing nearly around 12,000 call contracts. That's not great news. Short point, support seen at around 11,750 to around 11,750. That's from where we did bounce the last time around. While crucial resistance seen at around 12,100 odd mark. Besides trade tensions as well as geopolitical tensions, we'll track the big central bankers this week. The US Fed, what will they do? The Bank of Japan as well as Bank of England. So big week in terms of these big central banks.
All right, big week in terms of big central banks. Before I ask you what the stocks you're watching out for today, I know the stocks you were watching yesterday, the stocks of Virat Kohli, Rohit Sharma, and all our boys in blue.
Absolutely, Mangalam. I was so pumped up yesterday, but once rain came in there and the writing was on the wall, 7-0 to our Indians. But the kind of energy that these matches bring is phenomenal. I just want to tell the boys out there, we have won that crucial encounter against India-Pakistan, but I'm not settling for less than lifting the World Cup. So totally pumped up in terms of the World Cup action. But let's talk about some stocks in focus. Zee Entertainment, that was a little nervous in Friday's trading session. I'll be looking out for some kind of clarity coming out from the management because the street is not baking in that Zee Entertainment deal will not happen. If that doesn't come about, not just from a group point of view, from the market point of view, it won't be great news. So Zee Entertainment is one stock you'll end. It recovered a tad bit from the low point of the day, but in Friday's trading session, at one point of time, it was down nearly around 7%. Reliance Infra, finally they came out with a set of numbers. Keep the numbers aside, the auditor has raised various concerns and questioning it whether or not it can survive as a going concern. So that stock as well continues to be in focus. India Bulls Group stocks we'll be looking at. They've released additional pledge in terms of India Bulls Housing Finance. I think now the entire pledge has been released. In terms of India Bulls real estate as well, out there as well, there was some pledge release over the weekend. So good news coming in for the India Bulls Group. Jain Irrigation, the problem is pledge, high debt. They've increased their pledge out there. So not good news for Jain Irrigation. In terms of pharma stocks, Cadila Health, one of their arms, they got an EIR from the Ahmedabad unit. Good news coming in there for Cadila Health. Divi's Laboratory, the Andhra Pradesh unit was inspected by the US FDA. And wow, no 483s coming out of there. So that as well should go down as good news. Loris Labs, the US FDA, they completed the inspection at one of the API facilities. Out there, they're saying 2 observations, but procedural in nature. So I would imagine all these 3 stocks should open up in the green. In terms of technical action, PC Jewelers, they've re-entered the FNO ban, so keep an eye out on that stock. Coromandel International out there, the Gujarat Pollution Control Board, they have revoked the earlier closure notice for this particular plant, so some kind of relief coming out of there. And BHAL as well, they won a couple of EPC orders. So good news. I think that's about all the stocks that we can look forward to.
All right, that's a
Power
long.
breakfast. We're seeing some recovery in the Asian markets. In fact, the SGX Nifty, which earlier indicated that the start could be lower by about 5 to 6 points, has now moved into the green and indicating perhaps a positive start to the tune of around 10 to 15 points. In fact, the Nikkei, the Korean markets, all of them are at the high point of the day. Big reason for that perhaps could also be the positivity that Hang Seng is showing right now, higher by about 1.5%, 350 points in the green straight off the bat. And the Shanghai has actually not fallen too much, is just flat, is underperforming the other indices, but that's on account of the macro data that came in. The May industrial production was the lowest in the last 17 years. The Straits as well as the Taiwanese indices, which were low by about 0.5% at the start of the show, have now recovered to trade with mild cuts of about 1/5% to about the 1/10%. So we have some recovery in the Asian markets, most of them at the high point of the day. But let's talk about the trade war. On the trade tariff front, India has decided to go ahead with retaliatory tariffs on 28 US goods. Remember, this notification on retaliatory tariffs by India on the US goods was first promulgated in June 2018. However, the imposition of additional duty was deferred on 9 occasions, but now the Indian government has decided to go ahead with it. This move comes a day after the US Secretary of Commerce Wilbur Ross pitched in for a significant import duty cut by India. Addressing the US IBC India Idea Summit in Washington on Friday, Ross had said that India's applied tariff at 13% was one of the highest in the world and was also much higher than that of the United States of America. He also told the audience that the Trump administration withdrew the GSP benefits as India was not providing equitable market access.
The U.S. is the least protectionist major country, and we have the trade deficit to prove it. For example, India's average applied tariff rate at 13.8% remains the highest of any major world economy. Its bound tariff rates, the maximum level which it could go to on products, is much higher both than the actual tariff rate in many cases and certainly far higher than ours. I explained to the Prime Minister and others in the government while I was in New Delhi that the U.S. trade rep would hold off on its GSP decision until after the election so that it would not interfere with it. They were not addressed, unfortunately, and therefore, because, to quote from the President's proclamation, India has not assured the U.S. that it will provide equitable and reasonable access to its market. President Trump therefore terminated India's GSP designation as a beneficiary development country on June 5th.
India's trade deficit has remained steady during the month of May, coming in at $15.36 billion versus $15.33 billion in April. This as exports surged from $26 billion to $30 billion and imports also saw similar rise. Let's move on and talk about the Finance Ministry then. The Minister of State for Finance, Anurag Thakur, chaired a pre-budget consultation meeting with representatives of digital economy and startups. He sought industry's recommendations for the union budget. Here is what industry representatives had to say after the meeting.
Two topmost critical priorities put forward by NASSCOM. We have a copy almost of your entire pre-budget memorandum. But what is the key concern as of now, and what is the expectation? Will this July 5 budget, does the government have enough time to address any of these issues?
Yeah, I think the government has been working with the industry for a long time in consultation, so I'm sure they will have time, and they get the problems, they get the issues. It's not new. I think from a criticality perspective, we talk about this $1 trillion digital economy. It's within our reach. It's really within our reach. We just have to get a few pieces in place to ensure we realize it. The biggest piece is looking at the ID services and BPM industry. That's the base. That's what contributes to nearly more than 1/3 of the digital economy. And it has tremendous potential and opportunity to grow right now. We have to ensure that there is a industry-friendly SEC policy in place for the next 15-20 years that takes into account the changing competitive dynamics. So that's a huge ask for us. Second, just overall ease of doing business, but we need increased investment in R&D. We've asked R&D incentives, and the details are there. Look it up. We've asked for increased investment in talent. And for startups, we have to have a sustainable growth model. We have to ensure that we don't just get startups to start in India, we get startups to grow in India. So that's going to be, yeah.
Okay, one last question on this. Any discussion on taxing the digital economy? Because here India has put up a very strong plea in the OECD.
The government was just listening to all the different inputs. So each one of us had our agenda items. And our point of view is you have to relook at the entire taxation regime for the digital economy.
So as from the IT industry, our basic plea has been on extending the SEZ benefit and also the distribution tax, which is very high, dividend distribution tax. And on that, we have given a lot of data points from international agencies like OECD, World Bank, and IBFD, where a lot of countries like China, Sri Lanka, Vietnam, Philippines, Malaysia, Singapore, these countries have zero tax rate or tax rate between 10 to 15% on IT as an industry.
Correct.
Whereas, as per OECD, and rightly so, our corporate tax rate, including the dividend distribution tax, is actually at 48.3%.
Okay.
That's really out of the world.
Yeah.
The world is in a region of 10%, which is the Middle East countries, to a maximum of 29.7%, which is Japan. And the world average is about 23%. And the FM, few years back, the previous FM, he had mentioned very clearly the target to be 25%.
Which has not happened.
Which has not happened. And
is it going to happen?
Either we get the average tax rate to 25% or we extend the benefits that are there. Otherwise, as an industry, we will just be uncompetitive in the world.
Right, stop. Thank you. Thank you, sir. Thank you very much.
18, well, the pre-budget consultation meetings continue at the North Block as the Finance Ministry counts down to the Union Budget on the 5th of July. Chief Ministers from various states met Finance Minister Nirmala Sitharaman with their wish list. Here is what some of them had to say after the meeting they had with the Finance Minister.
पूरे राजस्थान की हमने जितनी भी योजनाएं जो बाहर की फंडिंग होगी उसके बारे में हमने बातचीत करी है। इस प्रकार से हम चाहते हैं कि जो लोन वेव हुआ है, कर्जा माफ़ किया था, हम लोगों ने पूरा कर्जा माफ़ कर दिया है, भूमि का बैंक का भी और कोऑपरेटिव बैंक का भी। परंतु नेशनल बैंक जो भारत सरकार के साथ में लिंक करती है, हमने कहा है कि वन टाइम सेटलमेंट जो आप करते हो इंडस्ट्रीज के साथ करते हैं, उद्योगपतियों के साथ करते हैं, वन टाइम सेटलमेंट किसानों के साथ भी करते हैं।
देखिए, उत्तराखंड में हमारी कुछ ऊर्जा से संबंधित परियोजनाएं हैं जो विशेषज्ञ समिति ने जिनको प्रेफरेंस दिया है, उनको लेकर के बातचीत हुआ है। वो जो लंबित बड़ी परियोजनाएं हैं, आधी अधूरी परियोजनाएं हैं, उनको लेकर के बातचीत हुआ है। और उत्तराखंड सरकार ने रिवर रिज्यूमिनेशन के कुछ प्रोजेक्ट लिए हैं और कुछ पॉन्ड्स डेवलप हम लोग कर रहे हैं। तो उस समय हमने भारत सरकार से अनुरोध किया है कि आप उसमें आर्थिक मदद करेंगे तो हम जो पानी इकट्ठा करेंगे, वर्षा जल का संचय करेंगे, उसे नए सोर्स भी डेवलप होंगे।
All right, and finally, the Finance Ministry officials also held pre-budget consultation meetings with the trade union representatives. Sapna Das caught up with the General Secretary of AITUC, or ITUC as we know it, as well as the President of the Indian National Trade Union Congress. and began by asking them about the key points discussed.
Gave a charter in which we covered all the points in various sectors, formal and informal economy. What do we want to say? Our highlights were that we want a fixed term employment, which was decided last time by the finance bill, must be withdrawn, because it is most dangerous thing for people having no job security, and it will lead to lots of unrest. So we are asking not to go ahead with the codification of labor laws the way it is proposed, and labor law changes and this whole fixed term employment. That's our focus we put. Secondly, we said that for Indian economy it will be too bad to wind up public sector. That which has accountability, it's with people's money the public sector is made, and public sector has done good to economy, rather has helped even private sector to grow.
But these are companies which are sick.
No, it's a profit making. Public sector units are also being wound up. There is no more thin layer that those which are loss making, they will be wound up. They are winding up even the profit making public sector units. So we have said this is wrong politics, and this is wrong commerce, this is wrong economy. Third thing which we are saying is that job losses have happened hugely. Unemployment rate has increased. So in that given situation now, what we are getting to know, even GDP growth which was claimed is 2.5% less than that what was claimed. So in such a situation, it is better that we concentrate on job creation, controlling job losses, and in the job creation we said that labor intensive activities should be enhanced more and more for more of jobs creations in the home-based sector, in micro sector, in medium industry, in small-scale industry. Lots of investment should be there.
And also the fact that 18,000 rupees should be the minimum.
Then the third area which we put as a focus was the minimum wages, because 7th Pay Commission had already accepted that 18,000 should be the landmark. It should not go below this. And now 3 years have passed. Looking at price situation, it should become 20,000 rupees. But government found out some so-called expert committee which told the data to be brought to the level of 9,000 or 10,000 rupees. Which is even less than what Delhi government decided to pay. So we are sticking to not less than 20,000, at least 18,000, which the government of India's own expert committee within 7th Pay Commission has done. It should not be done.
The matter is that they're creating an employment potentiality most. Public sector industry has got vacancies, they are not filling the vacancies. Lakhs of vacancies there in public sector industry, railway industry, but they are not filling, and they are employing the contract workers. Therefore, we say that if existing vacancies filled, near about 1 crore job can be given immediately. Second point, we said about the privatization of the public sector industry. We strongly believe that profit-making public sector should not be privatized. Sick industry is there, we are ready to discuss that matter. But profit making, when the nation is getting a good profit from the industry, that industry handing over to a private people, that means income of the government of India, you are handing over to the private people.
So which are such examples of profit-making CPSEs where privatization has really happened?
Number of there. Recently, Planning Commission has given a published a list. All the industry which was said that are like BHL making a profit, steel making a profit, but still they want to privatize. All the port they want to privatize, railway privatization, everything is going to privatization. There is a big loss, employment loss, profitability loss, and the nation is going to lose major industries and major potential of the third point. We said minimum wage. Today we are minimum wage. 7th Pay Commission said 18,000 rupees minimum wage, but nowhere it is implemented in private sector. So we want that 18,000 rupees should be implemented as a minimum wage, and according to the cost of living is going up. The minimum wage should be revised according to that.
The wage code bill that the government is planning to
No, we said we are strongly opposing. Today individual labor laws not implemented. There is a question of 4 code can be implemented. It is very difficult to implement this situation.
Okay.
And Narega, the agricultural labor, Narega workers, That scheme should be strengthened more and more so that the agriculture labor can be given a employment and the living standard can be improved. Narega is one of the best scheme which was introduced previous government. That should be strengthened and expanded.
All right, let's move on. And it's not just the two-wheeler makers who are not sold onto the government's idea of a complete switch to electric vehicles over the coming years. Commercial vehicle manufacturers, even those who already make electric vehicles, are also raising concerns over the financial viability of this move. CNBC-TV18's Jude Saneth reports.
Earlier this year, Ashok Leyland began gearing up to deliver 50 electric buses to Ahmedabad's Bus Rapid Transit System or BRTS. But the company admits it is spending most of its EV investment towards product development and very little on building capacity. This means that Leyland does not see much immediate potential to make money from electric vehicles.
But I think it's a little too early for us to quantify numbers and, get too excited about, the CV business at this stage. This is a development that will happen, I think, but it will take about 3 to 5 years before we can see it actually getting into some kind of a, solid, touch and feel.
Leyland is not alone. Mahindra Electric has been working on creating sustainable mobility infrastructure for Tamil Nadu's experimental township Auroville for over a year, and still implementation has not begun. Tata Motors, which has already delivered 160 electric buses to public transit networks in 5 cities, also points to poor visibility when it comes to financial viability for the manufacturer and the user.
Since a commercial vehicle is always bought for business purpose, it should make sense, economic sense, and therefore the cost per ton kilometer that internal combustion engine is delivering today, the same kind of economics should be delivered with electric vehicle. As we stand today, I think still there is a difference which needs to be bridged.
Now, this has not stopped companies from pushing ahead with their EV plans. Mahindra Electric has reported that its EV sales have risen 2.5 times in the last fiscal, even crossing 10,000 units in FY19. And M&M's EV plant in Bengaluru is set to touch 25,000 units in capacity soon. But unless the platform turns financially viable quickly, forcing the switch to EVs may not be good news. In Chennai, Jude Saneth.
All right, session of the 17th Lok Sabha is set to begin today. The first 2 days of the session will be devoted to the swearing in of the newly elected MPs. Prime Minister Narendra Modi is expected to address the lower house before the swearing in commences. The Prime Minister will also take his oath as a member of the 17th Lok Sabha, followed by the oath taking of the rest of the council ministers.
All right, let's talk about some other news. Patients seeking medical treatment are in for a harrowing time, with doctors set to go on a 24-hour strike today. The Indian Medical Association has said it will go ahead with its 24-hour strike call for closure of all non-essential services, including OPDs, from 6 a.m. on Monday to 6 a.m. on Tuesday. It, however, said emergency and casualty services will continue to function. In the backdrop of the attacks on doctors in Kolkata, the apex medical body has demanded a comprehensive central law in dealing with violence on doctors and healthcare staff and in hospitals.
All right, eye on the cricket field. We've been saying there is a recovery in the Asian markets. So most of the indices currently at the high point of the day. So we have the Shanghai, which opened absolutely flat, now has surged about 0.75%. So we have the Shanghai as well as the Hang Seng being the leaders in the Asian market right now. The Nikkei too closer to the higher end of today's trading range. The Straits as well as the Taiwanese indices, remember at the start of the show, were 0.5% lower. Now they are about 0.25% higher. So a massive recovery seen out there. In line of that, the SGX Nifty is indicating now the start would be positive in the to the 8 to 10% range in the green. But individual stocks, all of them will be in focus. ADAG group stocks have been in focus all through last week. But Reliance Infra, that one's come out with its fourth quarter numbers, and Anisha is take us through the highlights. Anisha, the numbers finally come.
Well, yes, after deferring the results twice, the company did come out with its Q4 numbers. But Mangalam, I don't know how much credence or importance we should give to this number, because the auditor has actually issued a disclaimer of opinion telling you that the auditors are saying that we cannot vouch for the numbers that have been reported by the company. They say we are not sure whether the numbers reported give you a true and fair picture of what's going into the business. So that really is the key worrying point, and that will be the talking point in day-to-day. Separately, the auditors also point out how the amounts recoverable from a related party is a whopping 7,100 odd crores. In fact, that during the year itself, the company gave some guarantees to the tune of around 1,775 crores. And do remember, this is more than the market cap of Reliance Infrastructure itself. So that would definitely raise some questions. Other than that, the company has taken out around 6,600 odd crores from the General Reserve, barring which the losses would have been to the tune of 9,000 crores. Because do remember, in Q4 itself, the company reported a loss of around 3,300 odd crores. Yes, there is exceptional impairment to the tune of 1,900 odd crores, but barring that as well, the numbers aren't very impressive. The liabilities have come off, but do remember the equity in terms of the balance sheet is down by around 10,000 odd crores. The company has separately written off the entire investment in Reliance Naval, plus taken some impairment hit for Reliance Power, EPC business, etc. But the talking point definitely will be the auditor's notes for today.
Absolutely, Anisha. The auditors, they continue to focus on the balance sheets and giving modified opinions. But let's talk about commodities then. Manisha Gupta joins us with all the update from the commodity space. Hi, Manisha. Good morning.
Morning, and thank you. Well, what a week previous one has been in sense of gains in the crude oil prices, and much of those concerns coming in from Iran and Strait of Hormuz, where a latest statement from U.S. now says that they will do whatever it needs to be done to ensure that the passage of the oil tankers is done on a safer note. The crude oil prices will continue to take premium out of that. And then apart from that, over the weekend, there have been statements from the Saudi oil minister that the 1.2 million barrels per day of a cut pact between the OPEC members and Russia, there is unanimous agreement on that. But the meeting clearly now has been shifted from 25th June to first week of July. So 3rd or 4th of July is when Russia and the OPEC members will meet and talk about the second half of 2019. This is majorly the point when the refineries come back from maintenance, the seasonal demand picks up. And with the geopolitical tensions that we have seen between Iran and Saudi and Algeria, etc., the expectation is that the crude oil prices will be supported. And this is happening even as the US dollar index is trading at a 2-month highs. We have seen other currencies continue to decline. Important to watch would be the US Fed meeting in this week, where the expectation of a rate cut is very low. But it is in July that the CME shows that a rate cut expectations are as high as between 60 to 80%. So that would be something to watch out for. In the meanwhile, the metal prices have also started this week on slightly positive note. So whether it is steel prices or copper, we are looking at 0.25% to 0.5% of gains on LME for these as well.
All right, Manisha, thanks a lot for that. So definitely keep an eye out on how that pans out. But for our markets, let's take a look at what's taking place in the flows and the F&O space. The Nifty over the last 3 trading sessions has lost some ground. So it's ended lower for 3 trading sessions, and that can be attributed to the fact that the FIIs, they are pulling out money from the cash market. In fact, the FII flows have thinned. For the month of June itself, they've sold about 80 crores. But over the last 3 trading sessions, we've seen either a mild purchase or more selling by the FIIs, and Friday was no different. But in index futures, there was a mild purchase again, 366 crore worth long positions added by the FIIs. The interesting place was in the index options. Why is that? Because the Nifty now is at the lower end of the 11,750 to 12,000 range. So maybe a lot of people are playing for a bit of an upside, but if that wasn't to happen, a lot of people are playing also for a downside. So 13,000 both long and long calls and puts were added. More importantly, there were more short calls added than short puts. So that's telling you that even if there is a recovery from the lower end of the range, the market would be in the range, and 12,000 would provide or would be a bit of a barrier to cross for our markets. And that was reflected in the sort of put call writing that we saw as well. 11,900 call and the 12,000 call together added close to around 22 lakh shares in open interest for a cumulative premium of around 50 rupees. So that's telling you that around 11,980 to 12,050 would be a bit of a barrier zone for our markets. We also saw some writing at the 11,950 call. So short point, we're in the lower end of the range. Let's see where we go from here.
All right, Mangalam, thanks a lot for that. But with that, it's a wrap on Power Breakfast. We leave you with the picks of our bullseye contestants for day 1 of the week.
Our first call is a buy call on PI Industries for a target of 1250, stop loss 1128. Second buy would be on Vocart for a target of 414, stop loss 377. Third buy would be on Cummins for a target of 798, stop loss 743. And final call would be a buy call on Tata Elxsi for a target of 900, stop loss 841.
My first call is buy call in SBI Life at the rate 700, place a stop loss at 685 and look for the target from 750. My next call is sell call in Bank of Baroda at the rate 119, place a stop loss at 123 and look for the target from 110. My third call is sell call in DLF at the rate 178, place a stop loss at 184 and look for the short term target from 165. My last call is sell call in Divis Lab at the rate 1520, place a stop loss at 1560 and look for the target from 1450.
The first pick for the day is a buy on Intellect. One can initiate long positions for a target price of 285 and maintain a stop loss below 269. The second pick for the day is a buy on PI Industries. One can go long in the counter for the target price of 1225 and maintain a stop loss below 1135. The next pick for the day is a sell on Biocon. One can initiate short positions for a target price of 238 and keep a stop loss above 252. The last pick for the day is a sell on Balkrishna Industries. One can go short in the counter for a target price of 735 and maintain a stop loss above 778.